Hello there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist of Sierra Alpha Research, and thank you so much for joining me here on my weekly show on Stockcharts TV. Great to be back with you as we watch the equity markets, risk assets, other things just pounding to the upside. June 2025 so far has turned into a pretty strong month for the equity averages. We know the S&P 500 and the Nasdaq, as the weeks progress here in the month of June, both of them sort of exiting from a consolidation phase, a short-term coil pattern of sorts, pennant pattern maybe, and now resolving to the upside. And in last week, I've actually had a number of questions about a potential bearish momentum divergence on the S&P 500. So today we're going to dig into divergences, talk about what they are, how we can detect them. We'll talk about why it may be a little premature to declare the chart of the S&P 500 as having a valid bearish momentum divergence, but I'll also share what I'll be looking for to confirm that particular signal, which could be a quite bearish sign for the equity averages. I'll show you an example of a classic bearish divergence on the S&P 500 chart and another major top from previous market cycles. You have a great example. That's a great one to save on a chart list for a rainy day for the next time we have a potential divergence. Good example to refer back to. We'll talk about how divergences can happen in a bunch of charts, equities, ETFs, and I have some examples queued up. We'll talk about newer Dow theory, which is a sort of a modernized version of Charles Dow's work, looking at potential divergences between major indexes. Should be an interesting discussion. If you're into divergences and into charts, I think that you'll find this pretty informative. By the way, if you're looking for my market recap show, that's called Chart This with Dave Keller. It runs every weekday after the close at 5 p.m. Eastern, and you can find that on my YouTube channel called Market Misbehavior with Dave Keller. Also, don't forget to check out the Market Misbehavior podcast. We're just over 50 episodes in. It's been a ton of fun. I've interviewed some classic stock charts commentators like Tom Bowley, who I interviewed last week. My latest episode is with Jessica Inskip. Jessica's the director of investment research at stockbrokers.com. And a lot of experience working with retail investors. And we talked about sort of second level thinking, which I think was a really important sort of investing concept to think about in this particular environment. It's so easy to get caught up in just the headlines, the flickering ticks, the sudden reactions. But if you go a level down, really think about what it means for interest rates to go up or down, etc. I thought it was a really interesting discussion, thought-provoking. You can find that on my YouTube channel as well. Also, we're on all the major podcasting platforms, Apple Podcasts, Spotify. So wherever you get your podcasts, look for Market Misbehavior with Dave Keller, if you would. All right, so let's talk about divergences today. We're looking at the chart of the S&P 500, and what is a divergence? Quite simply, a divergence is when price and something else don't agree. When price is doing one thing, but some indicator of some sort is doing something different. Now, when a market's in an uptrend, like we see with the S&P 500 coming off the lows from April 7th, and then pushing higher pretty consistently through April, May, and now into June, a potential bearish momentum divergence would be when the prices go higher, but the momentum starts to slope downwards. And you can probably detect, we're maybe seeing that start to emerge here in June of 2025. So the general concept is when a market is in a strong uptrend, you should expect to see stronger momentum readings. So if you just look to the left half of this chart, off of the August 24 low, we had peaks in August, in September, in October, November, and December of last year. And if you look, pretty much every one of those times, the RSI reading was higher and higher. That's a sign of a strong uptrend phase, a healthy bull market environment when the market's going higher on weaker momentum, when the market's going higher on stronger momentum, right? So higher prices, higher momentum, that is good. Now, what you want to start to be concerned about is when we start to make higher highs on weaker momentum. And this sort of general divergence that we saw in January and February, one of the many things telling us that we're probably near an exhaustion point, because we'd come out of this phase where higher highs had been marked by stronger momentum readings. All of a sudden we have further highs on weaker momentum readings, right? So sort of a different environment, what we call a change of character on the chart, where a price and indicator relationship has a certain definition and then it starts to change. So that change in that relationship, that bearish divergence, was one of the many things telling us, going into the February peak, we're probably at or near a significant top. Now, how does that relate to what we're seeing right now? We're going to come back to this chart at the end after we look at some other examples, but just to be clear, I would say this is a potential bearish divergence. And the reason why I say that it's a potential one is because this is still an active uptrend, right? As we're recording this chart, the S&P is at its highs for the day. It's actually been a pretty volatile session so far. So right now, we have the peak in May, and we have a higher peak right now. Right now, we have weaker momentum readings because the peak in May, the RSI is just at the overbought level at 70. But here in early June, we're making a higher high, but the momentum is weaker. Here's the problem with that particular conclusion, though, before you label it a bearish divergence. Let's say theoretically, and again, a hypothetical situation, let's say the S&P just goes straight up for the next 2 to 3 weeks, and we end up above 6,100 3 weeks from now. We're retesting previous all-time highs. If the market would just kind of gently trend like that, the RSI most likely continues to push higher. And so what looks like a divergence today will actually not look like a divergence as the price continues higher and if the momentum continues higher as well. So you have to remember that this is an active trend. So if you follow my work, anytime I say you have to be careful because it's an active move, that means we're still in progress. It's hard to really define, yes, this was a higher high on weaker momentum because it's still going, right? It's still kind of happening. It's really only a clear divergence once this second peak is established. You actually need to pull back from the second peak. So let's say tomorrow through the end of this week, the S&P rolls over, right? Another hypothetical situation. And if that would happen, then we would have a clear pattern of 2 higher peaks. Then we could look at the momentum and see, is that invalidated or is that diverged with the RSI sloping downwards. At this point, a little too early to say that because we're sort of still in an active uptrend phase. So you have to be careful when the market is currently trending higher. You can't judge the divergences too early. You have to wait for that second peak to be confirmed by a pullback in price. And only then can we start to make that comparison. Let's look at a couple other examples of divergences. And the more you see these, it's one of those things. The more you see them, the more they almost jump off the page at you when you recognize them again. Classic bearish divergence is at the 2020 peak, and it's so interesting. This is actually going into the COVID peak. I was at an event in early February of 2020. Ended up being the last travel I did for about a year or two. I forget how long it was before I got back on a plane after that, sort of the initial COVID shock. But it was a while, and I remember being down in Orlando at a money show, and it was people were talking about this virus from China, and there's starting to be U.S. cases. And I remember interviewing a couple of people there and asking them, like, how big of a thing do you think this is going to be? And it's so fascinating going back to those interviews now and just now knowing what we do now about what was just around the corner. I mean, we arrived back in the Seattle area, and then less than a week later, the announcement hit. So having said that, right, I think what's interesting is going into that second peak, we have a clear bearish momentum divergence. This is what I'm talking about, right? We have higher highs in January 2020 and February 2020. We have lower peaks in momentum. And I will tell you, an ideal bearish divergence is overbought on the first peak and not overbought on the second peak. Now, it's possible to have other combinations there where you have, the second peak may also be slightly overbought. But in my experience, the most idealized kind of plain vanilla, take a snapshot and put it in a textbook kind of example would be we're overbought on the first peak, then we make a higher second peak on the RSI not above the overbought threshold. So here we have the RSI around 65 as opposed to 75. So higher prices, lower momentum. And again, as we mentioned on the current chart of the S&P 500, it's a little premature to be declaring it a divergence until we start to sell off. So on that initial sell-off off of that secondary peak, when you can look and say, okay, that was definitely a peak, at least some sort of peak that we saw recently, and it occurred on weaker momentum, that's when I think you can validate it. It's also a great reminder, this chart, that these things don't happen in a vacuum. Remember, you have all the other tools in the technical arsenal to apply to a chart like this. So moving average support, price support, any other indicators like MACD or or other techniques, right? DMI, ADX, other things that will help you define the trend and identify potential reversals and anticipate support and identify if that support doesn't hold. All of those things are valid. So I would say don't treat divergences as a standalone. That's one mistake I find people make. They see a divergence and then all of a sudden they scrap all the other technical tools that they use. Remember, that's one piece of evidence among others. So make sure you do a thorough analysis of all the different tools that you have available. So again, after that divergence, we broke below the 50-day moving average. We broke below the January swing low. The RSI pushed below 50, pushed below 40. All of those things happened pretty early on in the COVID sell-off before we went all the way down to 2,200, right? I mean, so there were signs along the way telling you that this was a pretty significant drop as it was going. All right, so that's a great chart, by the way, and I'll include a link to this chart below. I have a chart list called Historical Charts, and anytime I find a great historical example, I lock in the date range, I put the notes on there. Sometimes I'll put comments just saying, like, this is what it means, and then I save it to a chart list. These aren't active current charts. These are just old charts that I think are great ones to refer back to, right? I've often referred back to this February 2020 peak. And so having a chart saved with what it looked like and the indicators that were meaningful at that particular point, I've done that for all the major tops going back for the last 30 years or so. And that was part of my own process of price discovery and analyzing historical market peaks. Now, are all divergences effective? Of course not, right? I would love to tell you, and a lot of people, unfortunately assume that when they see a new technical indicator approach, they assume it's always going to work. And then the one time it doesn't work, they go, well, hold on, how come it didn't work here? And the short answer is nothing in the financial toolkit of any sort, fundamental, technical, quantitative, none of it works 100% of the time. It just doesn't, right? And often the market will surprise us by doing unusual things that we don't expect. But I found divergences to be a pretty important thing to follow. When I've not paid attention to them, I've regretted it. So I wanted to show you a chart of the Semiconductor ETF, ticker SMH, and show you some historical divergences that we've detected in 2023 and 2024. Now, on the left kind of half of the chart, I've highlighted a series of these divergences with red lines. And these are all moments when there was a confirmed bearish momentum divergence, where the price went higher, but the RSI sloped downwards. This one in June and July of 2023, another great one to save on a chart list somewhere. I mean, just a classic divergence. Higher highs on stronger momentum, and then finally we get one on weaker momentum. The RSI is overbought on the first peak, not overbought on the second peak. Again, similar to that previous example, sort of checks all the boxes. Then we stall out and then we break down. And look how we actually found support at the 200-day moving average. So great reminder that when you do get a divergence, look down to some of those key levels of support, moving average support, and look for where there could be an opportunity. We had another divergence in June and July of 2024, which ended up being the peak for the SMH over the last couple years. Similarly, we had a pullback to the 200-day moving average before bouncing higher. Now, it's not just the major peaks, where you also get some secondary peaks where you have these little divergences. Here's one on a shorter term time frame in December of 2023, slightly higher highs, slightly weaker momentum. It wasn't much of a pullback. We remained above an upward sloping 50-day moving average. Here we had one that just flat out didn't work. And full disclosure, I think it's too often we show a technical indicator and then just highlight all the perfect examples of where it worked beautifully. It doesn't, right? I mean, sometimes it doesn't. And I think that's an important reminder of, what would invalidate a bearish divergence. And this is going to get us to, or similar to what I talked about with the S&P 500 chart earlier, what invalidates a bearish divergence is when the price goes higher and the momentum improves, right? So here we have higher highs in February. Let me zoom in a little bit. In February of 2024, higher highs on weaker momentum, right? So you can see the peak in January, overbought RSI around 80. Peak in February, overbought RSI around 75. Peak in late February, not quite overbought, RSI around 79. So that's a bearish divergence, right? We'd expect a pullback. Now, the pullback never really happened, right? We actually rotated back higher and the RSI improves. So the moment the RSI goes back above that overbought threshold, that says, nope, the divergence was not confirmed. It's not a valid one. We're probably going to continue higher. So that's an important way to think about it. These ones that I'm highlighting were validated because a breakdown happened soon after. We could confirm the divergence by breakdowns of support, right? Sort of all the other parts of the technical toolkit, holding support, breaking moving averages. These are all things we would look for. These examples where those things don't happen, those follow-through moments don't come, and especially when the RSI goes back to the overbought region, that sort of says, nope, it wasn't much of a divergence. The momentum is still quite strong on this name. So looking to the current chart of the SMH, obviously growth stocks are very much in the driver's seat right now in June of 2025. Similar to the chart of the S&P 500, I think it's premature to be declaring this any sort of bearish divergence. If we peak today and it drops lower for the next 3 sessions and the RSI breaks lower, then maybe we would validate a potential bearish momentum divergence. At this point, it's an active chart, still going higher. I think it's premature to be declaring that a divergence at present. AT&T is another example just to show you it's not just growth stocks or major benchmarks. You can find this on any stocks or ETF. I think once you sort of get familiar with how they look, you'll start finding them on other charts as well. And I would say just remember the specifics that we talked about in terms of recognizing sort of the classic divergence, saving some of those examples to refer back to them. Confirming when it is a valid divergence by a breakdown in price, recognizing when it's invalidated when the price goes back to overbought. One example I wanted to show you here was AT&T, just to show you that it happens on all sorts of names. This is a pretty conservative name within communication services, one of the old telecom names. But also remember that when you have a divergence, it doesn't necessarily mean we're going to have a significant sell-off, right? That S&P example from February of 2020, that was the COVID drop. And so the S&P obviously lost quite a bit of value soon after that bearish divergence. Don't think that that's what divergences always mean. Sometimes it's not a price correction, but more of a time correction. I would argue that's what you're seeing with the chart of AT&T. A bearish divergence doesn't necessarily suggest a significant drop in price. It basically means some sort of corrective move is probably happening. But remember that markets can correct in one of two ways. They can correct in price, which means it pulls down, or correct in time, which means the uptrend stalls out and we just kind of go more sideways. And that's really more what we see with the chart of AT&T. Confirmed bearish momentum divergence with the early March peak and the early April peak on much weaker RSI readings. But instead of breaking down in any significant way, we actually held the swing low from March immediately after the divergence, but we just sort of remained in this sideways trend. So the divergence was less of a we're going to drop in price action and more of an indicator that it's a correction. And the correction in this case, more of a time correction, right? More of a pause in the uptrend. Now, we may be actually renewing that uptrend here this week as AT&T is potentially making a new 52-week high, new all-time high with the RSI pushing just above 60. So maybe an eventual resolution to the upside after a time correction following that bearish divergence in March and April of this year. Now, divergences don't happen in a vacuum, and I would encourage you to remember that some of the foundational work in technical analysis actually had to do with divergences. Charles Dow in the early 20th century wrote a series of essays which is now known as Dow theory. Charles Dow was, really the father of technical analysis. He created the idea of indexing and analyzing index trends over time. He really defined uptrends and downtrends in a way that we still very much use as technical analysts today. But he also focused on what we call Dow theory, which is looking at different indexes and when they confirm or deny one another, right? So if the Dow Industrials and the Dow Railroads, which are the two main indexes of the day in Charles Dow's time, he would say if they're both breaking out to the upside, that's a bullish confirmed structure. If one of them is breaking out and the other one is not, that's a bearish non-confirmation is what he called it. But it's basically a bearish divergence where one of them is breaking out and the other one is not. The reason why I wanted to highlight that is because we had a pretty classic bearish divergence using what I call the newer Dow theory. Charles Dow used the Dow Industrials and the Dow Railroads. I would say those indexes are not particularly meaningful in 2025. So I use the equal weighted S&P 500, which is ticker RSP. That's an ETF that tracks that index. And the bottom panel is the equal weighted Nasdaq 100, ticker QQQE. The idea is if both of these are making new highs, that's a bullish confirmed structure. You can see that like back here in early 2024 when both of them make a new 3-month high, that sort of validates the uptrend. When one of them breaks out and the other one does not, that's a bearish non-confirmation. We actually saw one of those at the July and August 2024 market peak, eventually resolved to the upside as both eventually made a new 3-month high. However, we also had a bearish non-confirmation in February of 2025 at the February market peak, where the equal-weighted Nasdaq made a new all-time high and the equal-weighted S&P did not. That was, again, one of the many indicators we were watching that told us that that February peak was one to be questioned, not one to be embraced. Now, what's happened in the last couple months, though, is coming off of that April low. I would say by mid-May, both of these back to a bullish confirmed reading as both made a new swing high. I'm watching this one this week because the equal-weighted Nasdaq has made a new high for the cycle, breaking above the early May peak, but the equal weight S&P has not quite done so. So we have a potential bearish non-confirmation in the works. Can we declare that as a confirmed pattern today? We can't. It's similar to the chart of the S&P and the semiconductor ETF. It's an active move, right? So if the market continues higher and if the equal-weighted S&P pushes above that May peak, it's not a non-confirmation. However, if that divergence holds, if we see a rollover in these indexes and one of them has made a new peak and the other one has not, I will definitely make some noise about that being a bearish non-confirmation. So that brings us full circle back to the chart of the S&P 500. I hope you found this to be a helpful rundown of what a bearish momentum divergence actually represents. It's when the price moves higher, but the momentum readings are no longer supporting the uptrend in price. We can see some major tops in history like the COVID peak. Other peaks like 2007 and others have classic bearish momentum divergences. I would encourage you to dig into some of those historical charts using the Stockcharts platform. You can learn a lot by looking at previous market cycles for sure. Now, with charts of the semiconductor ETF, charts like AT&T, you'll find that it doesn't always work. It's not perfect, but by using other tools in the technical toolkit, we can either validate or invalidate some of the divergences that we may be seeing. I think we're seeing some potential divergences developing on the S&P, on the Nasdaq, and using what we call newer Dow theory, but it's a little too early to declare that. I hope you found this helpful. If you want to follow these charts along with me, and I'll share with you when I see any potential momentum divergences to share, check out my market recap show. It's called Chart This with Dave Keller every weekday after the close, 5 p.m. Eastern on my YouTube channel called Market Misbehavior. And don't forget about the Market Misbehavior podcast. I'm actually interviewing George Noble in a little bit from now. George is one of the first portfolio managers at Fidelity. He's actually the first international portfolio manager at Fidelity in the early 1980s. He interned with Peter Lynch and went from there for a successful career in the mutual fund industry and the hedge fund industry. I'll be chatting with George. A lot of other great interviews on the Market Misbehavior podcast, so you can find more of my great conversations there. For Market Misbehavior, I'm Dave Keller. Have a great week, and remember, it's always a good time to own good charts.